You don't even know what a write-off is. Do you? No, I don't.
Whenever I talk about tax write-offs, I think about this episode of Seinfeld where Jerry and Kramer have no idea what a tax write-off is. Jerry and Kramer are not alone, because many Americans do not understand the tax code. You're probably already aware that you don't need to pay taxes on all your earnings. But the daunting question is, what can you legally deduct from your taxes to lower your total taxable income? One quick note before we get started. The system is set up to benefit business owners and investors. Now you could either complain about it or start your own side hustle and use these deductions to your advantage. Here are 10 ways you could potentially lower your tax burden. Did you know that the IRS allows you to write off your mortgage interest or rent? If you run a business from home, the IRS allows you to take advantage of this deduction. You can write off your mortgage interest or rent, utilities, and even home insurance. Let's say the square footage of your home office is 1/10 the square footage of your entire house. This means that you can deduct 1/10 of the cost of your mortgage interest or rent, utilities, and even homeowner's insurance. You can also deduct 10% of other house expenses like cleaning, exterminator fees, and so on. Now, if you don't want to keep record of all these expenses, there's a simplified way as well. With the simplified method, you don't need to go through all the hassle of keeping all the receipts. However, you could be leaving a lot of money on the table. By the way, the IRS allows you to take advantage of this deduction only if you're self-employed. Businesses own assets like computers, furniture, copy machine, and other equipment that wears out over time. The IRS allows you to write off or depreciate part of the cost of these assets over time. For example, if you own rental properties, those can be depreciated over a period of 27.5 years. That is why seasoned investors love rental properties. Then manufacturing equipment like tractors can be depreciated over 3 years, cars and computers can be depreciated over 5 years, and office furniture and appliances can be depreciated over 7 years. However, to qualify for these deductions, you must meet 3 requirements. The asset or property has to be used for business or income producing activity. You must own the property. And finally, the property must have a useful life of at least 1 year. What if I told you that the IRS allows you to hire your kids and do legitimate work for your business and get a massive tax deduction? If you hire your children, you can legally deduct their salaries from your business income as business expense. But it gets better. If you pay your child under the standard deduction of $12,950, you don't have to pay any taxes on the income they earn. Basically, your child does not even have to file for taxes, as long as their pay is under $12,950. This way, you're not only lowering the tax burden of your business, but you're also transferring some of the income to your children as wages for services they perform. If you have more than one child, the same would apply to second, third, or even fourth child. All this while they earn a little money and start saving for college or even their first business. If you're a business owner filing for taxes, you're in luck. As a business owner, you can get tax deduction on travel, office supplies, if you have a home office, or even your vehicle. The lines between personal expenses and business expenses are somewhat blurry. Many billionaires even claim hairstyling and their private jets as a business expense, so you may want to be careful. Travel expenses are also deductible as long as the destination is away from the city you conduct businesses, and it should be over a full work day. You could go on a vacation and deduct that from your taxes, as long as you have some business activity in the city you're taking vacation in. Employee salaries are also fully deductible. This includes bonuses as well. Business property rent, utilities, auto expenses, insurance are all deductible. Let's say you purchase a house for $250,000 and use it as primary residence. After 5 years, you decide to sell the house. But the house has gone up in value by $100,000 to $350,000. Thanks to the home sale tax exclusion, the $100,000 of capital gains is tax-free. The IRS allows unmarried individuals to exclude $250,000 in profit from capital gains, granted that the property is used as primary residence. Married couples filing jointly can exclude up to $500,000 in gains. If you're an employee at a larger corporation, you've probably heard of the 401k plans. The 401k plans are tax deductible and they allow tax-free growth of your dollars. Though, these plans are only offered by employers. So, how do you take advantage of this plan if you're self-employed? With the solo 401k. With a solo 401k, you can contribute up to a whopping $61,000 and this money is tax deductible. This plan is designed for business owners with no employees, and the IRS states that even if you have one employee, you cannot take advantage of this plan. Although, you can use this plan to cover both yourself and your spouse. If you and your spouse run a small business, make sure you take advantage of this massive tax deduction. Roth IRA is yet another tool that the government offers you to take a break from taxes. A Roth IRA is an individual retirement account in which you enjoy tax-free growth of your assets. Not just the growth, but the withdrawals are tax-free as well. There are annual contribution limits, however. For example, if you make less than $129,000 per year, you can contribute up to $6,000 and reap the benefits. If you make over $144,000 in a year, you're not allowed to take advantage of a Roth IRA. There is one more caveat. You cannot withdraw money from your Roth IRA before you turn 59 and a half years old. If you withdraw before that, there's a 10% penalty. There are some cases in which this penalty can be waived. For example, if you're buying your first house, this penalty can be waived. A health savings account, or HSA for short, allows you to lower your taxes, easily pay for medical expenses, and even save for retirement. You can use an HSA fund to pay for eligible healthcare expenses and for out-of-pocket expenses that your healthcare provider does not cover. The HSA account offers triple tax advantage. First, the contributions in an HSA are pre-tax, thus reducing your taxable income. Second, the growth in HSA account is tax-free. And third, when this fund is used to pay for eligible healthcare costs, the withdrawals are tax-free as well. Just like Roth IRA and 401k, HSA contributions are also capped by the IRS. For 2022, the maximum you can contribute to an HSA account is $3,650. If you can afford it, it is a good idea to max out your HSA account to take full advantage of this triple tax benefit. Plus, when a person reaches retirement age, they can use their HSA for other expenses as well, and not just for medical purposes. The mortgage interest deduction is a tax deduction for mortgage interest paid on the first $750,000 of the mortgage. If you own a home, you are probably aware of this deduction. The mortgage interest deduction allows you to reduce your taxable income by the amount of money you paid in mortgage interest over that year. So if you have a mortgage, make sure you keep good records because they will come in handy when it's tax season. The interest you're paying on your home bill can help you lower your tax burden. For example, if you buy a $500,000 house and pay $25,000 in taxes, you can probably write off all $25,000 in tax deduction. A capital gain tax results when you sell an asset for more than what you paid for it. This gain is taxed according to your regular tax bracket if you held the asset or investment for less than 1 year. However, if you held this asset for over a year, say 1 year and 1 day, your tax bill will be significantly less. The wealthy navigate this in two different ways. First, they would simply hold the asset for over a year. Just by doing that, their tax bill is reduced significantly. Second, they use losses to offset their gains. So if you have investments trading at a loss, you could use those losses to offset your gains. I thought we would end the video with a fun one. A yacht, or a second home, is a technique mostly used by billionaires. Having multiple residences can reduce a rich person's tax bill. If you own a home, you can deduct mortgage interest and property taxes on your tax return. But what if you own a second home? Well, you can deduct the mortgage interest and property taxes on your second home as well. A yacht can qualify as a second home as long as it has sleeping quarters, a kitchen, and a toilet. This obviously does not apply to most of us, but who knows, maybe one day it will. I will end with this note. In 2007, Warren Buffett said he took a survey of his employees and compared their tax rates to his. He said that while he paid a tax rate of only 17.7%, the average tax rate of his employees was 32.9%. Reason being, Buffett is an investor, and a bulk of his income comes from dividends and long-term capital gains, which are taxed at a much lower rate than ordinary income. Maybe there's a lesson in there.